Thank you, Christopher. Good morning, everyone. It's my pleasure to call this meeting of the Seeking Fund to order. This meeting is a virtual meeting conducted by Microsoft Teams conference technology pursuant to Section 21-1503 of the Philadelphia Code. We will be recording. The recording will be available to the public online in the Sinking Fund website within 10 days. Joining the meeting, you are consenting to the recording, and your login, email, and or phone number may be part of the recording and made available to the public. I hope everyone understands that. The first item on the agenda is the approval of the meeting transcript. Is there a motion for approval?
Make a motion.
I'd second
Is
the
there a
motion.
second? And
Yes,
I heard
sir.
the second. Tremendous. Christopher, if you could put the agenda up, I'll be glad to move to the second item on the agenda.
Gonna give me a second for that. The next agenda item is a review of the monthly performance, Don.
Thank you.
Yep.
I'll turn that over to you, Christopher.
Thanks. Just real briefly, and I see we have Floyd and Alex from PFM here, and they'll go over the flash report. But just in terms of current total assets under management as of this morning, when I looked or checked, a little over $572 million. And there's about $6.58 million in cash, which would be a little bit more than 2.5 months of benefit payments. Alex and Floyd will go through the flash report, I'm sure offer some market commentary on the banking situation, the Fed's interest rate decision later today, and anything else that may be top of mind for the commissioners. So Alex or Floyd, if you want to jump in, the floor is yours.
Yeah, sorry. I apologize. My camera isn't working with the firewall or anything here, but I think Floyd's on the road, but he's available. It's been a volatile week. Obviously things are almost hour to hour, especially today with the Fed. But I'll let Floyd jump in with some broad comments.
Hello, everybody. Just really quickly, and I'll go with what we're seeing in the market. You're actually really now seeing a lot of the slowdown we're talking about. You're seeing that in consumer sector where it's consumers are now taking on more and more debt. You see it from versus in your credit cards. You're starting to see a lot of pullback within the real estate market, which is something we've been really pointing towards and kind of saying you're going to see that. This was the first time that year over year that we now have had negative home price appreciation. First time in 11 years. So, gentlemen, what we've been talking about, we are here today with that. And when you're looking at the labor, starting to see some of the labor movement, you're noticing that there's less people quitting jobs. There's actually you're starting to see more and more layoff announcements, which is something we have been talking about. But if you were to look at the scene overall, there still is about 1.7 available jobs to a worker. So there's still an abundance of jobs out there. So that is where currently this whole economic environment is. Now, pulling back the onion, and let me talk about the Fed really quickly. The Fed, because of what happened over the past 2 weeks with the banking sector, it was supposed to be a 50 basis point hike on the table, and that was all but certain. Now it looks like there's at least an 80% chance of a 25 basis point hike. There's some chatter about maybe the next hike might be 25 basis points, and that could be it, or it could be another 25 basis point hike after that. So that's what you're really seeing with the Fed right now. What has brought this slowing has been everything that's happened in the banking sector over the past couple weeks. I know that it's been a flash and a fury of emails going back and forth. Where does it stem from? It essentially stems from starting at Signature Bank, basically, them having to close their doors because they had more people asking for money than they had the money available. That then went into Silicon Valley Bank, which, they were forced to close their doors because they had the same issue. Then last but not least, you have seen that with, one other small bank, and is rolled over to First Republic, which, which with First Republic, what they've done is they've essentially worked with a banking conglomerate of 11 banks, led by JP Morgan, to help prop up their equity so that the bank does not quote unquote fail. Now you're noticing that I said three banks and mentioned a fourth. Is that a problem in the sector? It actually is not. When you peel back the onion, you'll notice that the three banks that have been forced to close were ones that did have a lot of hot money. What do I mean by that hot money? Three of the three had something to do with crypto. So you had that aspect dealing, those type of clientels. Then even with the main one, which is Silicon Valley Bank, which gets a lot of the publicity and headlines. With that one, that's the second major bank to fail since the global financial crisis. They had a lot of hot money from venture capital. So imagine from the time of 2020 to 2021, over a period of 6 quarters, you go from deposits of about 70 million to deposits of about 200 million. And that was from, low interest rates, a lot of money flooding into the venture capital market. And what did they do as a bank? They have said, okay, well, we have all these deposits. We need to go invest the money. Now, they did not consider duration, which was something that they did not consider with the investment of this money. And that created a mismatch, and unfortunately created the current demise that they're in. And I do think, even if you're looking at it from an outsider's perspective, it was, because you say the Fed created this whole thing, by the Fed increasing rates at a very rapid pace, they did contribute, but a lot of this does come down to risk management within the bank, which is why it's been seen more of it as idiosyncratic versus more systematic of the banking industry as a whole. Credit Suisse, if you're thinking about some of your international holdings, Credit Suisse is one that has definitely popped up, and of course, they're now being bought by UBS. Now, with Credit Suisse, this is a bank that has been dying on the vine. If you look at their stock price, essentially UBS bought them at a 99% discount to their 2007 um, peak price point. What does that let you know? That lets you know that this is a bank that's been embroiled in scandals. This is a bank that really has just not modernized themselves over the past decade. Their stock price reflected it, and when you're looking at it and kind of saying, well, with their last investor saying that they were not going to put more money into them because they were concerned about their ongoing viability, because this was a bank that had problems. Now, I think the one beautiful portion about this is that, if you're looking at it from a pure deposit standpoint, both, the federal treasury, and even the Swiss National Bank, they've stepped in respectively to both of both of the states, and kind of have said, hey, we're going to make sure that, all deposits are kept in line. Nobody's going to lose, quote unquote, any money that has deposited money there. And, that will be good for the banking sector and the health of the financial industry as a whole. Now, the pullback of that is, because this is happening, it does mean that banks are going to probably cut back on their lending. If they cut back on their lending, this now does have a negative impact on growth. So when you're seeing, a lot of the recession concerns that you already were seeing with leading economic indicators, you're seeing within the yield curve, this definitely pushes that recession concern over the, I was quote unquote, I would say over the hump, because bank lending is a way to where you can create credit, you can create money, and by not creating money, that does impede growth, which essentially will have an impact on our markets over the next couple of quarters going forward. Alex, do you
Yeah.
do you have anything else that I should touch upon, or um,
No, I mean, I think that sums it up nicely. I mean, our view most recently is I think we're beyond the immediacy of viability of some of these banks. And as Floyd just said, our latest view is, if you asked us today versus even 3 or 4 weeks ago, we would say, we see a recession being a little more viable now because of a potential mini credit crunch. So that's what we're looking at. The positives are that the strongest banks, the well-capitalized banks and governments have stepped in. Seemingly to provide a backstop. We'll see what regulations come of this, but and obviously we'll see what the Fed has to say today. Before we jump into performance, well, if you could leave that up, Bill, we're going to go through performance. But are there any questions on markets or anything before we jump into this?
I just wanted to ask quickly, what do you make of the way the Swiss government handled this? One thing that was striking to me was they kind of did what we think of the opposite of what's supposed to happen in this kind of situation in terms of the equity shareholders getting some of their money back, but a lot of the bondholders being wiped out entirely. That's kind of contrary, at least to the system we're used to. And I know there'll be some lawsuits and there's already talk of litigation about that. But when you're thinking about investing in the banking sector, is that something we should be worried about being the new norm, or does PFM kind of consider that an odd one-off event?
So my understanding of my understanding of this is, it's a relatively new class of security that was kind of created as a regulatory, backstop after 2008. Decisions, they're higher yielding decisions to seek investments there. It was like a convertible bond, the AT1s, decisions to seek, those versus, traditional preferreds or senior debt are, we believe left up to the active managers, and we use active management and fixed, or the plan uses active and fixed income. That being said, I think this may be the first instance of these like AT1 bonds getting wiped out instead of converted. So as you said, there'll probably be, some issues in court. It also sets an interesting precedent for the active managers as well. And, again, maybe this changes some conventional wisdom on this share class or security class. Sorry, Floyd, I don't know what you'd say.
No, and Alex, right there. I mean, the AT1 bonds. You also hear them called CoCo bonds in other places. The one thing to think about is take away the bond and kind of how they're viewed. They're really viewed as an equity tranche for all the rest of the bond holders. So when you look at them as more of an equity tranche for all the rest of the bond holders, then you really get a feel of the type of risk that you're actually taking on by holding them. And and the one thing within there, yes, there's going to be lawsuits, but they kind of looked at this and said, within these bonds, that was the main caveat within the bonds. This is the equity tranche. If you're the equity tranche, you can lose money or lose all of your money within there. So I do think it will allow investors to have a repricing of how they look at these bonds going forward, and really more. I think about the government. The government did what they had to do by if you actually try to save the equity tranche also, then you almost create a riskless type of bond. And that wasn't the goal of those AT1 or CoCo bonds when they were initially created.
Okay. Thank you, guys.
No problem.
So moving on, you can see here, and again, this on the screen is as of the end of February. So the plan, 569.2 million, plus I think there was roughly 10 million or so in cash, or so at the end of February. It's not included in that total value. The return for the month was an absolute negative return, -2.2 net of fees. Ahead of the benchmark, -2.6. The plan remains overweight to equities. It has been going back some time. That benefited the plan significantly in Q4 in January of this year. After yesterday, stocks are up again for the month, as well as they remain up year to date. While asset allocation was a detractor again for the month, in the intermediate and longer term, it continues to help. Certainly was an overall detractor for all of last year, but again, going back over the prior, looking at a 3 to 5 year market cycle, certainly equities have outperformed, and the plan has been there. Active management remains a pretty strong contributor to outperformance. PineBridge, just ahead for the month, continues to do quite well, over the 1 year period. So, it's brought itself back quite nicely. Within small cap, the decision to use, the S&P 600 index continues to be beneficial. I think if you look back at that over the 1 year, it's, significantly ahead of, the Russell 2000. And Copeland, remains, continues to outperform. They're actually on a price to earnings basis, priced a little higher than the index. That's by design. They've always sort of been higher quality based. That being said, their premium to the index on a price to earnings basis is the smallest they've ever seen. The cap structure of their small cap companies, we spoke to them recently. They did a look back, and most of their companies, they view their stronger banking relationships, cap structures, etc., as an advantage. So we'll look for continued outperformance there. I'll take a step back. PineBridge does have some exposure to Signature Bank. It's minimal. Signature is in talks to be acquired right now. I think the FDIC is working to broker that. I can't recall the name off the top of my head. Let me see. I do have it here. I'll have to dig that up, but there is a leading candidate to acquire Signature, but again, that's minimal holding at PineBridge. No Credit Suisse holdings at Acadian or Earnest. Again, their strong relative performance continues. No concerns with them. If you want to flip to the next page, Bill. As a whole, the fixed income managers continue their combined outperformance. Again, if you look at the top blue bar, minus 2.3 for the month. In the last 1 year, outperforming by a little over a percentage point. Some more modest gains in the core managers, for the month. We did, there was no direct exposure to Signature Bank. MetLife did have some exposure to the AT1s in Credit Suisse that we were just talking about. I think the total from beginning of month to the end of the month, or at least in March so far, I think the total impact will be about 25 basis points. So all the exposure we had in the asset class or the security that we were just talking about that got wiped out, essentially a default, equates to about a 25 basis point pullback. Again, stocks are up. Hopefully the overweight to equities will, more than offset that. Sky Harbor outperformed for the month. They continue to be, closely watched, although not formally on a watch list. We had a chat with them back in February. They remain underweight to energy. They remain underweight to triple C's, which is a position they put on in late summer. They are preparing for a bit of a downturn in the high yield market. As such, they're not reaching for yield. So I think that helped them a little bit in February, although there's been a bit of a rally here in March in the triple C space. So again, I think things remain volatile. We'll see what the Fed has to say today. Um, but we're continuing to keep a close eye on Sky Harbor, and may move them to watch list at the end of this quarter, depending on how things shape up by the end of March. But as a whole, we're pretty pleased with how all the managers have come together. Again, the allocation to high yield as a whole over the last year has benefited the portfolio, even when you account for Sky Harbor's underperformance within the asset class. So, taken holistically, the different approaches of the active managers in equity, the high quality S&P 600, general reliance on low cost indexing. We're pretty pleased with how the last year has gone, even in spite of an equity overweight that was working against the plan for 3/4 of the year. Longer term, based on valuations, based on an intermediate term outlook, looking beyond a potential recession, which if it happens, a modest one, etc. With a 3-5 year and beyond holding period for a pension, valuations at the beginning of the year were attractive for a plan, that with that type of risk appetite and long-term outlook, we see generally good things ahead. So, not recommending many changes. That being said, there is potential for volatility slowed down significantly yesterday. We're not saying it's gone. I mean, we do expect the rest of this year to have a lot of volatility, but again, the plan has shown the ability to withstand that. The appetite for that short-term volatility, and again, looking out beyond that, we see a lot of positive things. So. That's the end of my comments. I'll leave it up for any questions or discussion points.
Hi, Alex. It's Fran. I just have one question. When you indicated that you're considering moving Sky Harbor to watch status if things don't improve, is that a recommendation PFM would be making and the board would be deciding whether to put them on watch, or how does that work here? I don't think I've experienced that to date.
That is a good question. It's been a while. I know PFM's watch list procedures are independent, so they are not on watch list at PFM as of this moment, and a lot of that owes to the call we had in late February. They remain close, so our decision is independent. We would come to the meeting letting you all know of that change at our level, and then beyond that, I'm sort of at a loss as well. Chris, would that be a board decision to accept?
I think, yeah, the commission would be free if they wanted to also designate them on watch, or just, accept PFM's recommendation. Obviously, if the commission wanted to take other action, they would be free to do that as well.
Thanks. Thank you.
All right. And then I did look at the market value as of yesterday. It does mirror what Chris said. Roughly 572 with 6.5 in cash, and that's after another month of benefit payments went out. That's all for us.
Christopher, thank you. Are there any other items that we need to address at this point?
I just wanted to couple just really quick things, Don. I'm in the process of finishing up paying the calendar year fees. So either with the March flash report or the April flash report, the board or the commission, will get its annual summary of the fees paid. That usually comes out in the first quarter or early second quarter of each year. So I'll note that when it goes out. As Alex mentioned, we will have normal benefit payments. So I would expect in the next 30 days or so, I'll send out an email about where we may be thinking about raising, cash, since we have about 2.5 months of benefit payments. Obviously, if any of the commissioners or designees have any questions or concerns about what we're thinking, don't hesitate to reach out. And then lastly, I'm gathering just a couple final pieces of data from a couple of managers on the fourth quarter and calendar year MWDBE and local brokerage. So you should look forward to that coming out maybe as soon as the end of this week. If not, it'll be very early next week. You should get that in your inboxes. That's all I had, but happy to take questions if there are any others from the commissioners.
There appears to be none, but before I make a motion for adjournment, let me make certain. Are there any other questions that anyone would like to raise at this point?
No, sir.
Nothing from me.
All right. Is there a motion to adjourn?
I'll make a motion.
Second?
Yes, sir. I'll second that motion.
All right. So moved. Everyone have a great day. Thank you.
Thanks,
all.
everyone.
Thanks,
everyone.
everybody.
Take care.
Bye-bye.
Thanks, everyone.
Have a good day, guys.